Associate Professor, School of Management and Business Studies, Dr. Sajivan Abraham. The resource person today, Dynamic and Young CA Sreevats Gopalakrishnan. My colleagues in Managing Committee of Ernakulam branch of ICAI, respected commerce faculties of various colleges of MG University and other universities. Good afternoon to all of you. Welcome to the virtual webinar on Faculty Development Workshop on Accounting Standards, organized jointly by School of Management and Business Studies, MG University, and Ernakulam branch of ICAI, with the support of Accounting Standards Board of ICAI. During the last 3 days, we were able to discuss various accounting standards related to assets, accounting standards related to assets and others, accounting standards related to income statement and change in accounting policies. It was very well presented and by learned resource persons, C.A. Vinod Balajanjan, C.A. Asif Arafat Muhammad and C.A. Parveen Kumar. And from the comments we received, we could understand that all the sessions were well received by the participants. We should also acknowledge the excellent involvement of all these sessions by the participants. Today, on the final day of our Faculty Development Workshop, we will discuss on accounting standards related to income statements and others, particularly AS 12, AS 4, AS 29 and AS 7. The discussion is led by CA Sreevats Gopalakrishnan from New Delhi, an approved faculty of Accounting Standards Board of ICA. When I called him for the first time, I was under the impression that he is from somewhere from Chennai or from New Delhi or some residents. But when he told that he is basically a Malayali and from a well-known firm from Kerala, I was really surprised. But it's always we are facing surprise moments in life. We are happy to have his presence here today, and we are quite sure that the deliberations today will enrich your knowledge and empower you. On behalf of all of you present here, I extend a cordial welcome to the resource person today, CA Sreevats Gopalakrishnan, to this webinar. Welcome.
Thank you, sir. Thanks a lot.
Let me also welcome Dr. E. Sulaiman sir and Dr. Sajivan Abraham sir to this webinar. I take this opportunity to welcome all my fellow colleagues in Managing Committee, Vice Chairman C.A. Ranjit Warrior, Secretary C.A. K.V. Joss, SICASA Chairman C.A. Alan Joseph, and all others to this webinar. Finally, it is my pleasure to welcome each and every one of the participants from various colleges to this virtual seminar. One thing I want to tell you, friends, I would like inform that at sharp 5 p.m. we will have the validity session in which Accounting Standards Board Chairman CMP Sivakumar will be present. Vijay Kumar will be present along with Dr. Robinette Jacob, Director IQAC MG University. And Sajivan sir just informed that sometimes Robinette Jacob sir may be missing, but whatever it is, MP Vijay Kumar sir will be there. A feedback form already sent to your mail. It is in your mail. It will be active from 4 p.m. onwards, because whatever we sent already we received back the comments with all the comments. I think one more session is to be completed. So kindly fill your feedback form and submit it back. The certificate as well as the background material for the workshop will be sent to your email. The certificate will be issued as per the norms fixed and circulated in the brochure. So after receiving your feedback form, if you're complying with the norms, definitely you will be issued the certificates and the background material. That's all I want to tell you. Have a wonderful learning time. Thank you very much for the patient listening. Over to Joes for the further proceedings, please.
Thank you, Chairman Sierra Varghese. I am very happy and privileged to introduce today's resource person, C.A. Sreevats Gopalakrishnan. Sreevats Gopalakrishnan is a partner of K.V. Aiyer and Company Chartered Accountants, heading the Delhi branch of the firm. He holds CISA and DISA certification from ICAI. He did his articleship training with PricewaterhouseCoopers before joining the firm. His area of practice includes statutory audit, Ind AS implementation, risk advisory, and internal financial controls. He has over a decade of experience in the profession and has audited and consulted for public sector banks, PSUs, and several listed companies. He has contributed to the Accounting Standards Board of ICAI as a faculty on various accounting standards and in theirs. He is also an invitee to the Committee for Accounting Standards for local bodies of ICAI. He is associated with startup communities such as Head Start and Unlimited India by taking sessions and mentoring startup entrepreneurs. He is the co-chair of Young Indians Delhi chapter, the Youth Forum of Confederation of Indian Industries. He is a trustee of Noida Deaf Society, NDS, which is a pioneer institution in India that nurtures the deaf children. With these words, I invite and welcome CA Sreevats Gopalakrishnan.
Thank you. At the outset, thank you so much for the warm welcome, Joe sir. Respected Roy sir, Dr. Sulaiman, Sajimon sir, the Vice Chairman Ranjit Varia, SICASA Chairman Alan Joseph, KB Jos, and my thank you for inviting me for this workshop and also making me a part of this new beginning, where it's a joint venture between the Ernakulam chapter of ICAI and the MG University. I'm happy to be part of this workshop more because I am an alumni of the MG University, and it is a pleasure and a privilege and a proud moment for me to contribute by a little bit what I know towards this cause. So we have got about 1 hour 45 minutes, and we will be covering 4 standards. That is AS7 construction contracts, AS12 government grants, AS4 and AS29 we will cover together because both are related. That is contingencies and events occurring after the balance sheet date, and the provision and contingent liability and contingent assets. Before I begin, I'm sure this discussion would have been taking place in the last 3 or 4 days. With the Indian accounting standards, that is the Ind AS or the implementation of IFRS, there was a general feel, there was a general thought process that the accounting standards, as per the Indian GAAP, is no more to be applied. There was a confusion amongst the people of whether this is applicable, for whom it is applicable. Let me clarify that the accounting standards is still applicable for entities for which Ind AS is not applicable. Those are the entities which are not listed but with a net worth less than 250 crores, entities which are not NBFCs or banks. For all these entities, the accounting standards are still applicable. On that note, before I get into the standard, every standard that is being made or drafted and that is published as of today are on certain basic framework, and this framework underlines every single provision and clauses in the accounting standards, be it the accounting standards of India or the IFRS or any other GAAP. There are certain basic framework based on which the financial statements are prepared and presented. Let's delve a little bit of on this aspect for about a couple of minutes, and then with this as the basis, when you read the other standards, the understanding level and the requirement for various provisions in those standards will be well understood. Firstly is the underlying assumptions. These are all the basic accounting assumptions which all of us would have learned the moment we started learning accounts, which is the accrual basis, going concern, and consistency. I don't need to further dwell on this. You're all masters in this aspect. But every accounting standard or the financial statements is prepared on this underlying assumptions. Second is the qualitative characteristics of a financial statement. A financial statement is the picture of an organization for the multiple stakeholders for whom the organization matters. The stakeholders includes the owners, or so-called the directors or the management of the organization. It is also the government in the form of income tax department, the GST department, or the various other departments of the government, one of the stakeholders of the finance statements is them. And then there are also the stakeholders such as the banks who actually fund the organization. So for them to understand the picture of the organization, a very important qualitative characteristics are understandability, materiality. Materiality, whether the matters that is mentioned in the financial statement, the items that is mentioned in the financial statements, whether they are material, the relevance and reliability, whether they are comparable with the same entity across previous years, with that entity with another entity in the same country, with that entity with another entity in a different country. So comparability, constraints on reliable information. There are a lot of accounting estimates which we will also discuss in the subsequent slides. A lot of judgment involved in preparing a financial statement. So what are the constraints? And ultimately to give a true and fair view. So accounting standards are prepared keeping in mind these qualitative characteristics that a financial statement should have. Apart from that, what constitutes the various segments of a financial statement? One is the financial position, which is the balance sheet, and then is the performance, which is the P&L account. The balance sheet has got the assets and equity and liabilities. The profit and the performance has got the profit and loss account, which is the income and expenses. And then there is the shareholder capital maintenance adjustments, which is your reserves and surplus and then capital. So bear in mind that these are the basic elements or the framework for the preparation and presentation of financial statements, based on which all the accounting standards are framed. And every principle, when you learn that, when you come across those principles, you will see all of these characteristics or one of these characteristics being applied. Let's move on to the first standard of discussion, which is A7, construction contracts. So we will have we'll structure our discussion in such a way that I will have a brief overview of the requirements of the standards for a couple of minutes, and then post that if there are questions with respect to those standards, you may please ask them as once I finish that segment of that standard. We'll spend about 7 to 8 minutes on question and answers and then go to the next standard rather than waiting till the end for all the questions to come. So first is construction contracts. The standard objective is very simple. It is to prescribe the accounting treatment for revenue and costs associated with the construction contract. And the standard is applicable for accounting for all construction contracts in the financial statement of a contractor. For example, if a person has been given a contract to construct a building, or if he has been given a contract to construct a road, so he is the contractor, and this particular standard gives us the guidance for accounting for that contractor. A brief overview of this standard is there are broadly two types of contracts. One is fixed price contract and the cost plus contract. The standard gives a treatment for both of them, what constitutes them. Then there are multiple contracts. So the standard gives us guidance whether you should combine contracts or you must split a particular contract into multiple in order to recognize revenue and cost. Then comes the contract revenue and contract cross, the principles with respect to recognition. Then there is a principles with respect to the expected loss that you should recognize. Then comes the disclosure. So every standard will broadly have three aspects. One is recognition, identification and recognition. Second is measurement, what you have identified, how are you going to measure it. Third is disclosure. So these are the three broad aspects that is covered in every standard across. So in this contract, you identify the types of contract, then you measure those contract into revenue and cost and then expected loss. Then comes the disclosures. That is the last part. All right. So key terms that are involved in a construction in this standard is, one is a construction contract. Construction contracts are contracts that is specially negotiated for the construction of an asset or a combination of assets that are closely interrelated or interdependent in terms of their design, technology, and function, or for their ultimate purpose. Like I said, we discuss about two types of contract. One is a fixed price contract and the cost plus contract. For example, if a contractor has been given a contract to construct 30 floors of a building for 100 crores within a period of 5 years. So, and with an escalation clause that if at all the material or the cost or the labor price increases, there is a 10% maximum escalation per year on the increase in the cost of material, which he would have considered for the 100 crores. So this is a fixed price contract with certain clauses for escalation in prices over the period of 5 years. Whereas in terms of a cost plus contract, the agreement will be, okay, you please construct a society for me which has got 13 blocks. And once you construct, whatever cost you incurred, the person who's awarding the contract will vet that item and determine what are the costs he has incurred. And he will agree that, okay, I'll pay you 5% in excess of what cost you have incurred. Or he will say, I will pay you 20 lakhs or 5 lakhs in excess of what has been your cost. So this is the difference between a fixed price contract and a cost plus contract. Similarly, like I said before, there are contracts that has been entered, say a group of contracts has been entered, whether with a single customer or several customers. But there are scenarios when these multiple contracts should be treated as a single contract. This happens, say, for example, you are constructing a 10-floor building and each of the floors are to be owned by different people. But having said that, it was negotiated as a single package. All the contracts are related to one another. If only one particular flow gets, then the other gets built, the pipe connection, the electricity connection, and various other approvals will come all as one go. So the contracts are closely related and it's performed concurrently or in a continuous sequence. So even though these are all multiple contracts, it should be considered as a single contract for the purpose of recognizing revenue and cost as per this standard. Now there are also another scenario where a contract has been entered, a single contract has been entered for constructing various houses in a single society. And there were and in such a scenario, even though it's a single particular contract, it must be separated into multiple. When there are 3-4 conditions met. One, there are separate proposals being submitted for each asset. Each asset has been subject to separate negotiation, and the contractor and the customer have been able to accept or reject that part of the contract. And the cost and revenue of each of the asset can be easily identified. Like I said, in a gated community, if, say, for example, 10 friends come together and say they want 10 independent houses in the same locality, each one will have their own preferences, but for ease of managing that particular contractor, they would enter into a single agreement. So as far as the contractor is concerned, even though it's a single contract, the revenue recognition should happen separately for each type of asset. So these are the two broad aspects. One is you learned about what is a fixed price contract and the cost plus contract. The other is combining set of contracts and segmenting a single contract. Let's recognize, now we spoke about that the earlier part was identification, then comes measurement. Now, how do you measure a contract revenue? The components of contract revenue is the initial amount of revenue that's agreed in the contract. Then there are variations in the work contract. Whatever was planned initially, everything will not go according to plan, and hence there will be variation in the contract work. In terms of a building, say for example, a particular construction work had started for developing an international stadium. After about 7 to 8 months of the construction, there were certain approvals which the person who awarded the contract did not get. And there was delay about 3 months. Now, that delay has to be borne by the person who awarded the contract, not the person who's undertaking the contract. So the contractor in that case will make a claim saying that there are certain men, material, labor have been invested in this particular contract and I will need to be compensated for it. So in those cases, there will be a variation. Also, there are cases where the person who awards the contract says if he completes the work if the original period is 5 years, and if he could complete the work in 4.5 years or 4 years for that matter, there will be an additional revenue that he will be able to get, the contractor will be able to get at the end of the contract. So these are all the additions that can come, so that will be added to the contract revenue. Then there are also penalties. Now, a case opposite to the example I gave before, if there is a delay on the part of the contractor to complete the work, then there will be liquidated damage that will be levied by the person who awarded the contract onto the contractor. And that will be at a particular percentage or a rate of interest or a fixed amount. So those needs to be reduced from the contract revenue. So what you measure as contract revenue is the initial amount agreed plus a variation in the contract work on account of incentives or claims, less the penalties or the liquidated damages that the contractor may incur. Now let's come to contract cost. Once you recognize revenue, now let's look at cost. Cost, like I said, is the man, material, labor. Then there is also the equipment that you use, that you purchased for using for the construction activity. If there is a cement quarry that you have placed for crushing the cement, the sand, and all the other articles, then there is an investment in that machinery that you have made, and that particular machinery has got a useful life of 5 years. So the depreciation cost of that machinery will also become part of your contract cost. Apart from that, there will be a lot of cost incurred in transporting material, men, and all the other things for the purpose of the contract from and to the site. So those costs are also involved. Instead of purchasing an equipment, if there is a requirement for an equipment only for 1 month or in a sporadic manner, if not for continuous purpose. Say for example, there is a huge shortage of supply during a particular period of time. At that time, you would hire a generator set to run the construction activity. So the lease rental that is paid for that particular equipment is also considered as the cost of this contract. Apart from that, there are also the consulting. Say for example, there is an engineer who gives you the design and technical assistance for designing the construction activity. Those are also forming part of the cost. Now these are all the cost that's directly specific to the particular contract. Now, if a company like in Kerala, there is the Skyline Builders. Now, Skyline Builders have got multiple projects running at one point of time, but they have a head office in Cochin, and this head office cost, the overheads, that is the expense of the head office, the people who's heading construction, the people who are heading marketing, various other functions at the head office, which is indirectly involved indirectly related to the construction activity. They're also contributing to the construction activity, but not physically at the site. A portion of their cost also will be need to be absorbed. Something similar to, say, insurance that is taken for the particular project. Another aspect is the borrowing cost. If you have taken a loan from a particular bank for the purpose of this project, the interest cost that you're bearing for that particular loan will also be becoming part of the contract cost. So these are the three broad constituents of the contract cost. Now, certain things you should not include as part of the contract cost. One is the R&D and the admin expenses, which is not measurable at all. and which is not having a relation. If, say, for example, you have undertaken certain development activity, research activity, and it has not helped in the particular contract active construction activity, those will not be included. Similarly, if you have purchased a machinery, but on the anticipation that it will be deployed for the construction activity, but it was not deployed, it was laying idle, the depreciation on those machinery cannot be included. Similarly, the selling cost of whatever is the disposable items, those also cannot be included as part of the contract cost. We have determined in the previous slide what constitutes the contract revenue, which is the initial amount plus the incentives or any other additional payment that you will get, less the penalties that you might incur. Similarly, contract costs involves the men material directly spent. Then there are indirect costs at the HO, and then there are some other costs that are attributable to the contract activities like the insurance and the borrowing cost. So, how do you recognize? What are the ways of measuring contract revenue? The standard says you can recognize revenue based on the percentage of completion method. That is, what you determine the percentage of completion as on a particular date. What is the total contract revenue? And you apply this percentage on the contract revenue, you will arrive at the total contract revenue that must be incurred. Or you can say for example, in a large hydropower project, there is a multiple civil construction activity to be done where you build a power plant. Now that power plants, the civil activity of the power plant are distributed into multiple BOQs. That BOQ will be measured through the measurement book. Now on every balance sheet date, you can determine what is the total BOQ that should have been completed, what has been completed, the percentage will be arrived. So you can arrive at the percentage of completion either on total cost method or the amount involved or the physical portion in terms of units. The other method is you can do a survey and identify how much is the entire completion and accordingly arrive at the completion. So I'll give you a small example here. If the total agreed revenue that I have entered on a contract as on 1st October 2019 is 1.5 crores. As on 31st March 20, I have incurred cost of 1.2. And for me to complete the project, the cost is about another 0.2 crores, which is 1.4 crores. Now, how much percentage I have completed? Out of 1.4, I have incurred 1.2. So 85.71% is my total percentage of completion, and hence my revenue to be recognized is total agreed revenue of 1.5 into 85.71%. So this is the way you recognize revenue. Now, for this to happen, the standard has specified certain characteristics or requirements how this can be arrived, or what are the basic essentials. Now, for fixed price contract, it is very essential that the total contract revenue can be measured reliably. There must be some method, some strong judgments and assumptions and estimations involved, and there must be a lot of documentation to back up how much is the contract revenue. There must be the economic benefits that will be associated with the contract. There must be a probability that it will flow to the enterprise. Your contract cost that's attributable to the contract also needs to be measured reliably and identified. And ultimately, based on this contract cost, what you're going to incur and what you've already incurred, you should be able to arrive at the stage of completion. So it's very essential that all of these aspects are determined with reasonable certainty and documentation for you to arrive at the percentage of completion method revenue. As far as fixed price, similarly for cost price contracts, there must be the economic benefits, and the contract cost that is attributable to the contract should be measured reliably. Now, this is a scenario where there is actually revenue and there is profit. The contract says there are scenarios also that you had entered into a contract envisaging your cost to be X, but ultimately when you started the project, the cost went 1.5x or 2x, and come what may, you will actually incur loss. So you need not wait for the end of the project to recognize that loss. You should arrive that much earlier. So same example as I gave above, the expected cost of completion instead of 0.2, I have taken as 0.4. So what happens is, against a total agreed revenue of 1.5, I am having a total cost of 1.6, which means I am likely to incur a loss of 0.1 crores. So I will recognize the revenue at 75%, and that is 1.125. I've already recognized my cost incurred in my P&L, which is 1.2 crores. So in effect, I've recognized my loss also at 0.075. Sometimes it happens that your estimated original cost was 0.2, and you would arrive at the percentage of completion based on the original estimated total cost, but that is not allowed as per the standard. You need to anticipate losses and then recognize them. So those are the measurement aspects. As far as the disclosures are concerned, every balance sheet date, you should separately disclose what is the contract revenue recognized in the period. What methods did you apply for recognizing? Was it percentage of completion method based on cost, or based on units, or survey method? How did you arrive at the stage of completion? You should also separately disclose what are the total contract cost incurred and the recognized profits. Sometimes it happens that you have actually received advance for the work that you're already going to undertake. So that also needs to be disclosed separately. It also happens that if I have done, say, on a contract of 1.5 crore, I have done 10 lakhs of work. I have made a billing of 10 lakhs. The contract will also say that 10% he will retain as a retention money, or 5%. So in that case, that amount will be retained. So you need to separately disclose how much has been retained by the person who awarded the contract in your balance sheet. So these are the broad principles of the standard. I will take the questions that has just come. For example, office put up in construction site, any related expenses, is it added or not to the construction cost? Similarly, specific assets used for construction of that building, do we capitalize this depreciation? Okay, let me answer the first question. If there is a particular office that you have set up at the construction site, definitely that particular office will function only for that particular site, and that will come under the general overheads that's directly attributed to that construction activity, and it will form part of your cost. So a cost will include a depreciation of the machine. Say a computer has been installed there, so the depreciation of that computer will form part of the cost. Similarly, the salary that you're paying to the people, the accounts person who's in charge of the site, the store in charge at the site, those are all people who will function at the site, and those costs will be taken as your construction cost. Now, your next question is with respect to capitalization of depreciation. That's a different standard altogether. AS 10 discusses about the building of a self-generated asset. Now, this particular standard does not talk about capitalization of depreciation. What it says is that if a particular asset is used for construction activity, that asset's depreciation will be forming part of your contract cost, and it will go into your P&L account. So if, say, for example, you are a contractor, contract revenue will be determined by your percentage of completion, which I have explained before, and the contract cost will constitute of all of these expenses, your men, material, labor, depreciation, rental, all those will be part of your contract cost, and you arrive at a contract profit every year. There is no question of capitalization which is discussed in this standard. All right, the next question is just a small if we have expected loss, the entire project loss has to be recognized in the first year itself or over the period of time? No. So the entire loss need not be recognized in that particular period, only to the extent that you have completed in terms of percentage of completion. You need to recognize. The remaining can happen over the period of the contract. Just a minute. Is there any specific method of allocation of common cost? So there are no specific method as such for every entity that applies to every entity. Say for example, there is a HR department. Now the HR department has got say 10 people, and 10 people, and you have got about 5 sites running. So if you remove say two people who are in the HR department who are dedicated for the overall activity, there will be certain, you can on an average say, okay, each person, so there will be 2 people assigned, 1.5 man person or man month is involved in that particular project, and hence I will allocate that percentage of cost to that particular construction site. So those are based on which entity, what cost is incurred, and you will see what is the amount of relation to that particular activity, and then bring in the correlation to identify what is the allocation. So there's no specific allocation method, but if it is human cost, then you will say this, or say for example, you will say what is the total cost of all the projects taken together, and on an overall basis you will broadly distribute. If 100 is the total project cost of say 5 projects and 20 each, so approximately you will say 20% will go to each of the projects. All right. Okay, thank you. So I think we have done with 2 questions with respect to constructions. We'll move on to the next standard. Next standard is with respect to government grants. All right, so it is very important for us to understand what is government and what is government grants. Government constitutes the central and the state government. Government agencies as well. There are agencies under the government such as the Insurance Regulatory Development Authority, National Housing Bank, World Bank, and there are also local, national or international government bodies like the municipality, the corporation or WHO. So all these form as government. So for example, there are a lot of schools, there are colleges that are aided by World Bank, World Bank funded projects, and the construction activity is funded by them. There is also a lot of support that the fishery industry, the export industry get as benefit from various government bodies. So the government will constitute these 3 aspects broadly. One is the central and the state government themselves, government agencies, and then the national, local or international government bodies. Now, what constitutes government grants? What are grants? Grants are nothing but benefits or assistance in cash or in kind. This could be for a past activity that you did, or for a future activity they are going to do for which you have to comply with certain conditions. So subsidies, incentives, bounties. So these are all called government grants. All these, the entire discussion in this standard will revolve around how to recognize and account for government grants. So again, I told you every standard will have got 3 aspects. One is identification, recognition, then measurement and disclosure. So again, this standard, you will identify what are all the government grants. Second is how do you measure those in your balance sheet or financial statement. Last is the disclosure. Now there are certain things that are certain assistance that the government gives in the normal course which are excluded from the standard. First is if there is a normal trading activity that the entity enters into with the government. for which government makes payment to the entity as a normal customer. In that case, the particular standard will not become applicable. For example, if you are a real estate company owning a multiplex or a complex, so if a government department or government agency like the IRDA or National Housing Bank sets up an office there and you are leasing that office to that entity, that is outside. That is just a pure trading transaction that the entity has with the government. It will not come under the definition of government grants. Similarly, government also provides us a lot of tax holidays and exemptions under the Income Tax Act, under the GST and various other laws. Those also will not get covered. Similarly, government, apart from giving benefits and subsidy, are also owners of certain entities. For an example, Air India. Government is a shareholder there. Government is an equity participant there. So those transactions also are not covered under this standard. I'll give you a brief overview of the government grants, this particular standard. First, we will recognize the government grants. And for recognition, you have to look at what is the assurance of the compliance of the terms and conditions that you have to comply in order to become eligible for that government grant. And once that is done, is there a reasonable certainty of that government grant coming to us? Which means, say, for example, if that government grant is sanctioned by the government authority. Once this is determined, you will have to determine what is the accounting treatment. The standard broadly says two approaches. One is the capital approach, the other is the income approach. And if it is the capital approach, which we will discuss in the next slides, the grant is treated as a shareholders fund. It is not a promoter fund, but it's in the nature of a promoter fund. I said the equity contribution from a government is excluded from the standard. It is excluded, but the normal expenses which an equity shareholder will provide, if government is providing that as a grant, then this treatment, a capital approach will be adopted. But if it is in the nature of income or reimbursement of expense, then an income approach is adopted. In the capital approach, it will hit the balance sheet alone. In the income, it will hit the P&L as well as the balance sheet. Now, there are also non-monetary consideration. Say, for example, the Apollo Hospital in Delhi actually was awarded to the Apollo Hospital by the central government at 1 rupee. The entire land of the hospital was awarded ₹1. Now, that is actually free of cost. So in that scenario, you will record that asset as a nominal value of 1 rupee. Similarly, if the government says, okay, you please develop an SEZ in the interiors of Uttar Pradesh. Now, if that special economic zone is developed there, the government says, I will give the entity the land at a price of 50% of what is the ruling rate in that area. So then it is at a concessional rate, then you will account it at an acquisition cost. So if 100 was the market value and you acquired 50, you will recognize that as 50. These are the two non-monetary considerations. Otherwise, every other grant will be accounted under the two bases of capital and income approach. This is what the standard says. So let's talk about both approaches. One is a capital approach. So if in case of capital approach, you will credit directly to the shareholders' interest, which is the capital reserve coming under the liability side of the balance sheet. And if it is the income approach, like I said, it will be taken over income. Now, there are certain criteria. Until and unless these are met, you should not recognize a government grant. One is there is reasonable assurance that the entity will comply with the conditions attached to them. So the government will say, I will give you the particular grant if you set up a unit which is 50 kilometers from a town which is having a population of only, say, 30 or 40 people. If you set up a unit there, I will give you this. So there is a condition attached to that. Then secondly, there is also and you have to comply with that condition. Secondly, there is a benefit has already been earned. And ultimately, the collection of the grant is certain. Now, until these criteria are met, you are not allowed to recognize a government grant. Again, the grants can be in three types. One is a specific asset. Example, there are a lot of export units which are in Kerala, which are into export of fishery products, marine products. Now, these are all perishable items, and hence a cold storage facility is a very essential part of this business. The Marine Products Export Development Authority, which is a government agency, has come out with a scheme for the integrated cold chain and value addition infrastructure, wherein it says that whatever machinery that you have procured for cold storage, there will be a subsidy of 50% of the equipment cost that we reimburse back to the entity. So these are all, this is a grant where it is for a specific asset. And these can be into two broad things. One are depreciable, the other is non-depreciable. If it is a depreciable specific asset, say for example, that asset is 100 rupees. Now you got a grant saying that 50% of the cost the government will bear. So you procure that asset, what are the various other conditions you comply with, and you make an application to MPEDA saying that I have procured this asset. Now you please give back to me 50%. So once the company receives this 50% back, the value of the asset which you had recorded at the time of purchase 100 will now be reduced to 50. And the subsequent depreciation, if that asset's useful life was 10 years, you will recognize depreciation of 10 each. 100 cost of machine is 100, depreciate over the 10 years. So 10 per year is the depreciation. Now once you receive this grant, the acquisition cost becomes 50, and you realize that there has got a remaining period of 10 years, so you will recognize depreciation as ₹5. So that is one method for depreciable assets. The other method is retain the value of the asset at 100 itself, recognize depreciation at 10, but in the same proportion in which you recognize 10, you should recognize the 50 that you received, which means at 5 rupees it will come as income, at 10 rupees amount depreciation will come as expense, net will be 5 rupees as depreciation. So both the methods that are kind of given to us in the standard. This is with respect to a specific asset and that to a depreciable assets. There are cases like land, which are non-depreciable assets. Now, in respect of such assets, if there are certain obligations that are required to be fulfilled in order to retain that asset, then the money that you receive for that asset will go and sit in your capital reserve. The capital reserve is coming under equity. Below the shareholders, within the shareholders' funds, it will come as an equity in the reserves and surplus. And you cannot use this particular capital reserve once it is recognized. So there is no charge to the income. Whatever amount that you receive as grant will be shown as a capital reserve. Now, if you receive this asset, if you receive this money, you procure this asset, you receive this money, but there are certain obligations that you have to comply with every year for a period of 5 years in order for me to have this grant. So there are certain expenses that are incurred for meeting those obligations. Say that, for example, if I am producing electricity, I will actually sell a part of the electricity at free of cost to the government for these areas. Or if I am producing sugar, I will produce at free of cost to these areas. Only if I do that, I will get this amount for a non-depreciable assets on which I have set up the plan. So I should recognize the government grant in the same pattern in which I am recognizing the expenses to meet those obligations. This is a discussion with respect to specific fixed assets when the grant is for that. Now, comes a case where government grants are given for the entire project. In order to develop the northeastern states, the government had come up with a lot of grants, lot of incentives, lot of subsidies for setting up plants there. There were a lot of cement plants set up in Arunachal Pradesh or Uttarakhand. Uttarakhand was a state that came into being in 2000, post the split from Uttar Pradesh. So at that time, there was a promotion of that state. In order to that, there were a lot of subsidies given. So government said, whatever is the total project cost, I will contribute 20% of that project cost. So the promoter will incur that expense, build the project, and then make an application to the government, and the government will refund that back. Even in this case, here the promoter is acting like the government is acting like a promoter, and hence this amount will be parked in capital reserve under shareholders' funds. The last is with respect to revenue item. For example, there is a company in Kerala called Fertilizers and Chemicals Travancore Limited. Now they are into the manufacturing of fertilizers. It is very important that every part of the country, for agriculture to happen, as we know, agriculture is the backbone of the country. For agriculture to prosper, there is a requirement to have these fertilizers reach various parts of the country at the right time. So government says, okay, in order to ensure that you do this at the in the shortest time, there is a subsidy given for the freight cost that you are incurring, and that subsidy may be at a per ton per kilometer. So whatever is the subsidy fertilizer that you are transporting, at a per ton per kilometer, you will get that as subsidy. In this case, there are two options. Whatever expense that you are incurring towards freight, the grant that you are getting can be reduced from the expense, or you show separately under other income as subsidy received. So, like I said, there are three types of grants: specific fixed assets grant for the project as a whole, promoter contribution grant, and grant related to revenue. Now, there can also, as I said before, there are also scenarios when particular grants that you have got. Now, for example, I have got a grant. Now, for me to enjoy that grant even for the next 5 years, I need to satisfy these stipulated conditions. And if I am not satisfying the stipulated conditions, I will be required to refund this grant back to the government. So, in such scenario, all the three cases, what is the treatment? So, in terms of revenue, the last fertilizer subsidy, the freight subsidy that I mentioned, what will happen is it will be applied first against any unamortized deferred credit remaining in respect of the grant. Say, for example, I got a grant. That grant, I will distribute it as and when I incur the expenses. And there is a certain unamortized amount. If I am able to refund, if I am required to refund that grant, whatever is the balance in the unamortized amount in the balance sheet, that will be knocked off, and the remaining will be charged off to P&L. Now, with respect to specific fixed asset, I said that if it is a depreciable asset, the gross book value of that asset will be reduced to the extent of grant received. Now, if I am not meeting certain stipulations and terms and conditions, this book value, I will say refund the grant back. When I refund the grant back, the book value of this asset will be increased to the extent I refunded. And hence, so for example, if the asset, as I gave example, is of 10 years, at the end of 5th year, you realize that you have not complied with certain stipulated conditions for various reasons. So you will have to refund the grant back. So after refunding the grant back, your total asset value comes to now 60. The depreciated value should have been 50, but you refunded 10 back, hence your depreciated value is 60. But you have got only 5 years left. So instead of depreciation of 10, your depreciation will now become 12. That is why grant with respect to specific asset, depreciable asset. Now, if it is the non-depreciable asset, you will reduce the capital reserve. So as I said, if it is non-depreciable asset for which there is no obligation, it will be parked in capital reserve. And when you're refunding it back, it will be reduced from capital reserve. Same is the case with grants in the nature of promoter contribution. So this is a small example. A company received a grant of 50 lakhs in 2007 from state government for installation of pollution control machinery. The company failed to comply with the conditions and was required to refund the grant in 2009. What happened is the company had debited the said amount to its machinery on payment of the same. It also reworked the depreciation. Now the question here was, should I rework the depreciation thinking that I have never got the grant, or should I recompute from the prospectively? That is from year 5. So the standard there is a clarity that you should arrive at the written down value as on the date of refund, add the refund back to that written down value. Whatever is that arrived value, you depreciate over the remaining useful life. Like key disclosures are very simple. You have to mention your accounting policy for the various types of grants that you have received and the nature and extent of government grants that you have received over the period. We'll take up questions. Okay, non-monetary grants like non-current assets, we record at what value in books. So as I said, for example, a land is given, or a set of machineries is given, or a building is given as a grant. In that case, if it is at free of cost, then you recognize it at ₹1 as a nominal value in your balance sheet. Like I said, in case of Apollo Hospital in Delhi, they received the entire land for the hospital at ₹1 from the Prime Minister at that time, 1990. So in that case, they will recognize in their balance sheet at ₹1 that land. We increase the value of non-depreciable assets at the time of refund if we follow capital approach or under both approach. I am just not trying to understand. We increase the value of non-depreciable asset at the time of refund if we follow capital approach or under the both approaches. So in both cases, say in your depreciable assets, you will actually increase the cost of the amount. But in case of non-depreciable assets, it is only capital reserve. So the question is with respect to capital reserve or no capital reserve. If there is capital reserve involved, you will only adjust to the capital reserve. And if there is no capital reserve involved, then you will make adjustments in the corresponding asset. And if there is no corresponding asset, you will make adjustment in the profit and loss account. I hope I was able to answer your question. So, kind request little information about forgivable loans and loans at concession interest rates. So, by any chance you get a government grant and by chance due to natural calamities you lose the asset, how should we account for this? So, with respect to forgivable loans and loans at concessional interest rate, the government grant per se applicability will become it's a different thing altogether, because there is involvement of borrowing cost as well. So borrowing cost talks about the capitalization of interest and interest cost, whereas in respect of this particular aspect there is a interlay of these both standards involved. And I'm not able to understand this last question. If by any chance you get a government grant and by chance due to natural calamities you lose the asset, how should we account for this? So it is very simple. You have to look at the conditions under which you got the government grant. Now that is the predominant requirement. If you are complying with those stipulated conditions and you are able to ensure that that has been done, natural calamities are outside your purview. It is beyond your means. So there is no question of refund or anything in that case. So there will be no, and then it will come to your fixed assets. Now, whatever your fixed assets you have recognized, and if that fixed assets value is existing and it has a useful life, you will test for impairment and arrive at the book value. So there will be no impact on account of this aspect with government grants. Right. I don't find any more questions. So we shall go to the next standard, which is AS4, contingencies and events occurring after the balance sheet date. Now, treatment of contingencies and events occurring after balance sheet is the coverage of this particular standard. I'm getting another question. In accounting standards and Ind AS, both are still in existence. Yes, if it exists, how can a domestic company decide which one should be followed by them, whether AS or Ind AS? So, like I said at the beginning, the MCA has come out with a regulation, with a directive saying that all the companies whose net worth are in excess of 250 crores, whose companies are getting listed or already listed, or an NBFC or a bank, these entities are required to comply with Ind AS, but all the other entities will be required to continue complying with accounting standards alone. So, is a company allowed to follow either one or as they wish? There is always an open option on the part of the entity to comply with Ind AS if they choose to. But once they start complying with Ind AS, they'll have to continue complying with Ind AS. They can't go back to accounting standards. How much Ind AS just converts standard with IFRS is differentiated with accounting standards. So let me also answer this last thing in a very short way. There's a lot of concept of fair value, and if you want me to explain fair value, say for example, I entered into a contract with an entity for a period of five years, a single contract. Now that is for 100 rupees. As per the normal standard, as and when you satisfy the milestones as per the standard, you will recognize the revenue. But the Ind AS says you will have to see if a particular standard takes substantial period of time to complete. You will have to compute the present value of the 100 crores which you will receive over a period of 5 years. So, for example, if you're going to receive 20 at the end of each year, you will arrive at the net present value of that 100 in the current period, and the difference will be recognized in your P&L as time value of money. So there is a lot of interplay of fair value concept which is in the Ind AS, and that's a broad difference with the accounting standards. And also there are few aspects which is not getting covered on the accounting standards and is covered on the Ind AS. Say for example, financial instruments, hybrid instruments. A lot more detailed explanations are there in the accounting standards, in the Ind AS or the IFRS vis-a-vis the accounting standards. Right. So the standard broadly, as I said, talks about contingencies and events occurring after the balance sheet date. Let's talk about contingencies. Now, contingencies are that events that may or may not occur. The outcome of such event is not known at the balance sheet date. The estimation of outcome are required to be determined. There is a lot of estimation involved, and such estimation needs to be stated in the balance sheet. So these are the constituents or attributes of a particular contingency as such, and events that for which you have no particular clarity or a purview at this point of time. A lot depends upon your ways of estimation. One is certainty. With what certainty can you estimate on the ongoing and recurring activities? And that is based on certain and uncertain events. What is the expression of future events may be presented? What is the possibility of reasonable quantification? So, let me give you an example. A particular asset was prepared or a particular product was designed thinking that there will be a huge market. Let us take our own example. There was a company called Micromax. Micromax had got into the business of manufacturing mobile phones, a decade or old back, and they came in a big bang, and they had a huge boom in the initial period. And there was a lot of technology and built based on that. Machinery would have been purchased based on that. What happened is, with the certain change in technology in mobile phone that is happening, over a period of 2-3 years, it found its technology outdated. Now, the investment that he had done for producing those kind of mobiles were much large. So, what will be the impact of this particular incident? Say, for an Apple phone has come, or a competitor Samsung has come out of the phone, which has got better qualities but with lesser cost. The impact of this cannot be ascertained. It has got a lot of estimation to be involved, because now you need to see the same machinery that you used to produce those phones, can I use it for some other purpose? So that is the level of estimation that is required in such scenario. So the outcome for which you have no certain clarity are those cases which is called contingencies. Now, there are contingent rates and contingent losses. As a matter of prudence accounting principles that we have learned all across, no contingent gains can be recognized in the balance sheet. For example, if there is an arbitration claim, if you are a contractor and you have put up an arbitration claim against the person who awarded the contract for various reasons. So this arbitration has been happening for about 2 years. Now, as on 31st of March, there is almost an in principle agreement between the parties saying that we will settle for an amount. So there is a certain amount of gain that is most likely will come. But the standard says you need to wait for recognizing those gains. You cannot recognize it on saying that it is almost reached a conclusion. Whereas, as a matter of prudence, contingent losses needs to be anticipated. For example, the counterclaim which a party has put, Gammon India, which is into construction of large projects, the approach that they adopt is they quote prices, they quote contract at a very low price, and a lot of cases of arbitration are brought in once the contract sets in. So at the end of the contract, a lot of amount the Gammon as a company, as a contractor, earns is to arbitration claims. So the person who was awarded the contract may need to provide for all this. So those are all contingent losses, and the standard says you need to estimate them with reasonable estimates. And in case of conflicting or insufficient evidence for estimating the amount, you just need to make appropriate disclosure. Now, about contingent liabilities, provision, etc., we will discuss in detail in the subsequent standards. So this is just to explain what contingent gains are and what contingent losses are. Now, this is the more important aspect of the standard, which is the events occurring after the balance sheet date. Now, these are broadly called the post-balance sheet events. Once the balance sheet date is crossed, say 31st March, but before the balance sheet is approved by the governing body, which is either the management, board of directors, or the trustees, the period between these two dates are called the post-balance sheet dates. Now, there may be certain events that occur between these two dates which can impact your financial statements. Those events that will lead to an impact or a change in the financial statements, assets and liability, those are called the adjusting events. And those that do not have an impact on the assets and liability are called the non-adjusting events. The standard talks about how do you go about recognizing for these aspects. You make adjustments in case of an adjusting event and make disclosures. In case of a non-adjusting event, no adjustment is made, but a disclosure is made in the report of the directors, that is the director's report. So in a typical case, on 10th January, the financial statements are made from the books of accounts. If, say, for example, the account year and date is 31st December, financial statements are prepared on 15th, 10th. It is approved by the board on 15th of January. And also ultimately, the shareholders receive the financial statements on 18th of January. So we are talking about 1st January to 15th January, which is the period where these events can happen. You need to make adjusting events. So in case of adjusting events, say, for example, we are supposed to receive 100 rupees from a particular customer. On the day, that is 31st March is the date, and you're approving the board, the accounts of the company on 15th of June. Now, on 15th of May, this particular debtor actually becomes bankrupt. He is actually, because of COVID, he has completely gone bankrupt. The amount that is to be recovered from him now will not be fully recovered. So in such a scenario, these are events that occurred post the balance sheet and for which you may have to make a provision in your books of accounts. So instead of 100, you will assess how much will you get, and accordingly, if the final is say 20 or 25 rupees, you will make a provision for 75 rupees. Those are called adjusting events. Whereas there are non-adjusting events. If there was, imagine there is for example, there is a national highway that is being constructed by a large infrastructure company from town A to town B. It's a newly inaugurated national highway which has been functioning. On 15th of May, the state highway completed construction of a state highway which actually ultimately links A and B, which runs parallel almost the same time and almost the good roads. What happens is, because of this new state highway that was built, the revenue that the company will get from the national highway will substantially reduce. This is also against the contract with NHAI, where NHAI said that there will be no parallel or alternate routes built. Now, this cannot have any impact on the assets or liability as on 31st of March. But it has got the impact on the future of the company, the future cash flows of the company. So these are things that require disclosure in the company's director's report, but not in the balance sheets. There are other events, say for example, COVID-19. COVID-19 has, for some entities, for valuation of inventory, it is an adjusting event. So if you are into apparel business, and this apparel, you'll have to be now, April, May, June was completely a dead month, and from July you'll have to start selling. So you may not be able to clear the stock at the original price at which it was meant to be sold. So you'll have to discount it. So the valuation of inventory will have a beating. But if with respect to moratorium of loans, now banks had given moratorium benefit till RBI had given till 31st August. Supreme Court extended to 30th September. We're waiting for a clarification. Now, whether to the impact of that cannot be taken on 31st March. However, it might require a disclosure in the director's report. So key disclosures, again, here's wherever there is a contingency found, you make a disclosure of those contingencies and the uncertainties involved which may affect the future income, and an estimate of the financial impact, if at all it is if it is possible to estimate. If it's not possible to estimate, a statement of that. Similarly, in case of post-balance sheet events, the particular event that has occurred should be mentioned, and an estimate, if possible, should be mentioned, or just a statement. Okay, so there is no questions as such now. We'll continue to the next standard. Both these standards are related, and hence this will be able to easy to understand. So this is the last standard, AS29, which covers contingent liabilities, provisions and contingent assets to ensure that appropriate recognition criteria and measurement bases are applied for provisions and contingent liabilities. There is sufficient information that is disclosed in the notes to accounts to enable the users to understand the nature and also to lay down the appropriate accounting for contingent assets. Now, there was certain question asked of what is a new thing in India. So these are the standards that is not covered here but covered in India. So, for example, financial instruments that are carried at fair value, executory contracts, insurance contract with policy holders covered under Ind AS, other Ind AS. So these are the exclusions from this particular standard. It predominantly revolves around the obligation that you have to others, maybe probable or possible. How do you recognize in the financial statements? Firstly, an overview of the standard. There is a present obligation as a result of an obligating event. You have entered into a contract. That contract gives rise to multiple obligations on a particular entity. Now, as on 31st of March or a closing end date, you have to recognize if there is any probable outflow on account of a particular contract's requirement, an obligating event, which you have not recognized as cost. If there is a probable outflow, if it can be reliably estimated, then make a provision. If there is no probable outflow, there is a remote outflow, but you are not very sure and you cannot reliably estimate the value of it, please disclose that as contingent liability. Then comes the scenario if there is no obligation as on today, but an obligation can come in the future. Then there is no requirement as of now. We will wait for the future thing to happen. So it has got to do with as on that date if there is an obligation. It does not include any aspect where there are possible obligations in the future. So I'll cover this particular slide in the subsequent slides as well. So there is no missing anything. So as far as provision is concerned, it is a very important. It is very important that there is certainty in the estimation that's done for recognizing provision. A provision is a liability which is a present obligation, and it is obligation based on evidence shows that it is probable that that particular liability will come. Say there is a requirement to pay minimum wages in a construction site. On account of various reasons, the workers have gone on a strike, and the strike demand is that there must be an increase in wages by 15 to 20%. And as on 31st of March, there is no finality on that particular aspect. But by management estimation, by historical data, by looking at the other entities in the same vicinity or in the same industry, the management knows that there will be a certain outflow on account of wage increase that was on account of the strike. So based on these estimation, because there is a present obligation and there is some data to back that obligation, the company will recognize that as a provision. So it is a present obligation and there is a data. Similarly, there is also events that will require future outflow on account of a past event, like a liquidated damage, which we discussed before. If ultimately you realize that there is a requirement to pay liquidated damage, if there is a court case filed in the court, and the opinion of the lawyer is that most likely we will lose the case and there will be a requirement to pay the amount, then also there is a requirement to make a provision. Now the estimation will be very uncertain. So in that case, you make a disclosure saying that what is the basis and on which that estimation and judgment was made. So what are the 4 conditions to be met if there is a provision? One is there is a present obligation arising from a past event. There is outflow of future economic resources which is certain and which can be measured with substantial degree of estimation. Another example which I mentioned here is an oil company which has been contaminating a particular land and does not do the cleaning up because there is no legislation requiring so. As on 31st March 19, it is virtually certain that a law requiring cleaning up of contaminated land will be enacted, and people who were littering that place will be required to clean it up or incur that expense. In such a scenario, you'll have to look at 3 aspects. One, there is a present obligation as a result of the past event, because the obligating event is the contamination of the land because of virtual certainty. There is a certainty that there will be future outflow of resources. You will have to clean that area, you'll have to employ multiple people and get that place cleaned up. And there is a reliable estimate that you can make for doing that job. And hence a provision should be recognized to the best of the estimates. Then comes contingent liability. In the same example that I mentioned earlier, if there is a case going on and the advocate feels that there is reasonable certainty we will win the case, the delay that was caused was on account of the person or the other party, and there will be no outflow. So you will have to make a disclosure in the balance sheet saying that this is an event that might come. It may not happen, but it might come. So there is a possible obligation. It is not a probable obligation. It is a possible obligation arising from a past event and existence confirmed only by of occurrence or a non-occurrence of certain. That is, you can confirm that only based on the court order. But you have a letter from the lawyer which is giving an assurance that we have got multiple factors which is for us. It is not recognized in the P&L as a provision because there will be no probability of outflow resources, and you also cannot make a reliable estimate of how much will be the outflow of resources, and hence contingent liabilities will be disclosed as a footnote in the financial statements. As far as contingent assets are concerned, these are all possible assets which will arise from past event, but as a matter of prudence, it is not getting disclosed in the balance sheet as an asset, because there needs to be surety whether you will be able to avail the benefits of a particular item to consider that as an asset. Because there is no surety, it's only a possible asset, it should not be recognized. It will be disclosed, and it will normally be disclosed in the director's report. As far as these aspects are concerned, for each class of provision at the balance sheet date, a brief description of the nature of the obligation and expected timing of any resulting outflows needs to be mentioned. What will be the movement? That is, what is the opening, what is the additional provision made, and what is the closing balance? And out of that provision, how much has been used, how much has remained unused? So this movement of provisions needs to be disclosed in the financial statements as far as provision is concerned. In case of contingent liability at the balance sheet date, you need to make a brief mention of the contingent liability wherever applicable. Like I gave in the previous example, if there is an income tax case that is being fought at the Supreme Court, which will significantly impact and will require outflow of resources of demand and interest and penalty. So an estimate of that should be made and disclosed in the financial statements. The fact of uncertainties should also be mentioned, and if at all there will be some amount of reimbursement, if at all there is some benefit that may accrue to us on account of this, that also need to be mentioned in the financial statements for contingent liabilities. for this, because we end the last standard as well, take up Q&A now. How do we compute or estimate the value for the provision? For example, compensation payable can be 4 lakhs or 14 lakhs when the case is in court. How the companies normally do this estimation? So, as I mentioned, in a particular case of certainty, I said if there are fights that has erupted between two contract parties, or if there is a strike with the laborers or employees, in such cases you make an estimate about the amount that will be requiring an outflow of resources. But there are cases where you will not be able to ascertain how much will be the outflow, and that is why if you go back to the provision, when do you recognize a provision? There is a present obligation on account of a past event. It will result in a future outflow of economic resources, and it can be measured with a substantial degree of certainty. Only if a substantial degree of estimation. So only if these 4 criteria are strongly felt, can there be a a provision made. If I am trying to understand your question well, if there is a dispute between two parties and there is a liquidated damage that is charged on me, and I have filed a case against that, I know what is the liquidated damage that they has charged. I also know that I also know that there will be interest and the legal fees he will reimburse from me. So I will have an idea of how much will be the total outflow, the maximum outflow. After that, I'm sure there will be some amount of leeway which we will be able to get and make an estimation. Now, all that will depend upon how strong our case is, what will be the view of the advocate in terms of the positions and the factors involved, and accordingly we will take a decision. It is not a very clear-cut case. If it is just a pure thing of wages or something like that, where it's a clear computation of X amount plus interest cost plus miscellaneous, then it can be easily arrived, but otherwise it cannot be easily arrived. So it is a management judgment which will involve, and hence that is why, to answer to the readers of the financial statements, we will have to make a disclosure of how those provisions have been arrived at. And if a provision cannot be determined, if you cannot put it into concrete figures, then you make a disclosure to that amount. All right. Next question is how the contingent assets are not to be disclosed in the balance sheet. Then why to calculate and where do we have to record or mention the contingent assets? No. So it is quite natural. See, accounting standards actually came into being only in 2004. 2003-4, that's when it started came. Even before that, there were only 1 or 2 accounting standards, but these series of accounting standards that you have seen actually came only at that time. Now, before that time, the balance sheet and financial statements were prepared based on the assumptions and estimates and judgments which the management and the auditor felt. At that time, I as an auditor will think that there is a good probability that a future event will happen and I will recognize that as an income, because I'm sure. Whereas another auditor will think that no, let me wait for that event to happen, and once that event happens and I'm sure, or if there is an agreed order or a contract agreement, only then will I recognize that income. This difference is actually what the accounting standards bridge the gap. It said, let not two people different in think way, let us all think in this correct way. And coming back to your question of contingent assets, it is to refrain people from recognizing that income. let us go back to the original basic concept of prudence, conservatism. You do not recognize income and gains much well in advance. To specifically refrain people from recognizing such asset and income, they have mentioned in the standard. And they have also designed how to identify that contingent asset and how not to recognize it. So there is no question of computation. It is actually more from the point of view of refraining people from doing this. All right. Next question is, so can the management decide whether provision to be made or just a disclosure only to be given? Even in this year, there might be any outflow of cash. It is mandated to create a provision. I will come back to the same question, the same thing which I mentioned earlier. These four are the key criteria. And most probably the 1, 2, and 3 are very simple, because you know there is an obligation on account of some past event that you have done, and there is a future outflow of economic resources. Now the question is, with what degree of estimation can you do? How certain are you about that outflow of resources is the key challenge here. So management is at a best stage. So another example that I can give is, if I am building so let me tell you from a bank's perspective. As on today, we are also auditing now State Bank of India. One major challenge that we are facing is, there is the RBI requirement saying that till 31st of August, please don't consider any asset as bad. So from March 1st onwards, government RBI said you need not pay your interest and principal, and even if you don't pay, you will not be treated as an NPA, which is a non-performing asset. Now, come to 30th September, Supreme Court says, wait for some more time, please give some benefit to the borrowers, because if you're going to charge those interest, whatever interest I have not paid for the 6 months, say for example, a person I have not paid from March to 30th September. Now, whatever I did not pay as interest, it will get converted as principal amount, and I will be charged interest on that. So if my loan amount is 100 and 12 rupees is the total interest cost for an year, 6 months interest is 6 rupees. So 6 rupees will be added to my 10 rupees, and I'll be further charged interest from 1st October. The Supreme Court has come and said, please don't do that. You please come out with a mechanism. Now, in such a scenario, on 30th September, what will the banks do? If the Supreme Court ruling says the interest has to be waived off, the borrowers need not pay, the banks should not recognize those interest as income. If the Supreme Court says, yes, you please go ahead and recognize, you please collect it and convert that, the banks can recognize that income. Or if the government says, let the borrowers not pay, the government will compensate the banks for the amount that the borrowers have not paid. Even in that case, bank can recognize an income. But having said that, all this requires a lot of judgment, because you need to know how many of those people, borrowers, will actually end up paying. Some of them will pay half, some of them will not pay. So to that, so what management will say, okay, it will see at historical data, how many people have defaulted, what is the credit the credit rating of this particular borrowers, are they good? On that, they will arrive at estimation saying that if I am supposed to receive 6 rupees, I will not receive 6 rupees, I will receive only 4. So let me make a provision for 2 rupees. So that's why it is purely a management call, and there is no hard and fast rule. But if you are not able to estimate with certainty what will be the outflow of resources, what will be the amount involved, then you cannot create a provision. At that scenario, you will create a contingent liability. Okay, so that is the answer. Let me just go back to that question, I think. So you are asking, can the management decide whether provision to be made or just a disclosure? This is my answer. All right. Okay, sir. Any more questions? So I have Roy sir, Joe sir.
Yes.
MPV sir will be coming by 5 o'clock, in fact.
Okay. Oh, I am ahead of time. I didn't realize that.
At 5.
Milind P, can you just Milind P has actually asked a question. Explain treatment of dividend. Milind, can you please explain in which context? Is it in government or is it in provisions? Is a proposed dividend. If the particular entity has proposed to make a dividend, then definitely it should make a provision to that extent. And if it is proposed to be declared at the board meeting in which the accounts are approved, then yes, there needs to make a provision for the proposed dividend.
I think no more questions. I think. Sreevats, we have finished all the questions now.
All right. I think I'm just going through all questions. If I have missed out any, the liability I will show that similar to a loan, and whatever rental payment I will distribute that as interest and principal and reduce the liability to zero at the end of the lease term. So what happens is this is a concept called off-balance sheet asset and liability. There are many such off-balance sheet assets and liabilities which the current accounting standards are not catering to. And hence the IFRS, the Ind AS brings in such a concept. Another example which I had told before, I will explain it further. I spoke about the fact of time value of money. If I have a contract to supply manpower or supply any material for a period of 5 years, and I will receive 20 rupees per annum for a period of 5 years, which is equivalent to 100. Now, we all know for a fact that 1 rupee today is less than 1 rupee tomorrow. So actually 100 rupees which I am getting today over a period of 5 years is not actually 100. As on today, if I put a net present value, discount it using multiple factors, whatever my borrowing rate, the accounting standard says that is your real revenue. And the difference between both the present value and the total 100, that is total 100 is actually the interest component. What you're getting is not the sale of goods. Actually, it represents the interest component in the contract value. So this is an aspect. Now, what happens is the reader of the financial statement is educated much more when he reads that such a financial statement. So these aspects are broadly brought about in the case which is the converged IFRS.
Sreevats, I think MPV sir is already there. Sir, MPV sir? MPV sir? And gentleman also, that's also I should say. and he was there to help us in conducting this faculty development workshop. And anyway, he's just coming out of one of his committee meeting which is going on there at ICAI, and because of our pressure, he is here. Sir, a great welcome to you, sir, to this validatory session. Great, thank you, sir. Thank you so much. And I think before giving a chance to Sir to address, I think some of the participants, 2 or 3 participants, I think they can make their feedback in few words. Maximum 1 or 2 minutes they can take. They can enable their audio and express their opinion about this feedback, please. Anyone?
Yes, all participants, video and audio is enabled now. They can switch on and speak.
Nobody is coming forward. Pavitra CB is already made his comment saying, I haven't done many FTPs, but this is a great FTP. Very few workshops are conducted on accounting standards. This is an excellent initiative. Who is there to give a feedback? Enable your audio and you can talk now.
Hi, sir. Is it audible?
Yes, Dr. Mustafa, you can. Yes. You're audible. You can talk, sir. Sir, please.
You, especially with all gentlemen, ICAI, I'm a teacher and also useful of these presentations, especially in connection with the IFRS, especially in this internationalizing the accountings. Thanks a lot to all these research persons as well as there should be a separate to be handed over all the connectivity issues. It should not be handed over by the chairman. Will be very nice. This networking knowledge, then it will be very nice. Okay, thank you very much, sir. Excellent.
Thank you, Dr. Mustafa. I think it was an excellent feedback. Anyone? There were so many lady participants who were very active in making their comments also. Anyone there to give us a feedback?
Am I audible?
Yes, you're audible. Yes.
I am Manoj Narayanan, Head of the Department of Commerce, Basilis College, Kottayam.
Yes.
The overall conduct of workshop was excellent. All the 4 days, we had 4 different resource persons. Their styles entirely different, but each of them were able to deliver to the best possible extent. We were very much benefited actually. In my feedback, I had also put a suggestion. Accounting standards, many accounting standards have been included in the MCOM syllabus of MG University affiliated colleges. So, if ICAI Ernakulam branch could come out with another set of workshop for MCOM students also, including the syllabus-based accounting standards, it would be of great help to the entire student community. Anyway, we are also fortunate to have a session with Vijay Kumar sir. We find ourselves very much blessed with his presence. Excellent conduct of workshop by ICAI, of course supported by the School of Management and Business Studies, MG University. We look forward for more and more follow-up workshops on AS as and when there are major changes. Thank you very much.
Thank you, Manoj Narayan sir. It's a wonderful feedback. And also, sir, MBB sir, they were asking for similar workshop for the students also.
Sure. We will do it. We'll do it.
So can we move to the validatory session?
And Jose, one more, I think. Let us see. One more. Anyone?
Okay.
Anybody from
One
one more?
female.
The last one. One lady participant, please.
I think one lady is trying to, Shrija is trying to unmute the button, but she's not able to.
Okay. Raju, can you help?
Sir, ആ മാഡത്തിന്റെ throat.
Sir, can I speak, sir?
Yes. We can hear. Yes.
Good evening to everyone. My name is Tasmia. I'm from Bangalore. I teach in St. Joseph's College of Commerce. To begin with, this session was very, very informative to us. We teach financial reporting as a part of our curriculum at our undergraduate courses. And this was amazing to understand each of those standards. It threw a different light. It gave us a very good perspective to how to bring this to our classrooms. We have been teaching this for the past 3 years now, but this way of teaching and the examples that you quoted were amazing. I thank all the resource persons for giving us a new perspective to each of these accounting standards and being so patient. There were sessions which were, there could be much more that they wanted to say, but because of paucity of time, we understand that not everything could be covered, but what was done was well done. So hats off to all of you. Thank you for ICAI Bhavan and also MGR University to put this up together. One of most informative accounting workshops that I have attended. So thank you so much for everything.
Thank you, Tasmia Hussain, for the excellent feedback. I think we'll always, with the help of Accounting Standards Board, ICA, as well as even MG University and other university, we will do our maximum. Yes. So I think, shall we go ahead? I think, Jose?
Yes, sir. So we'll go to the validatory session. Thank you for all the feedbacks. Definitely ICA will be there for helping our teachers and professors in this profession. So may I request Vice Chairman of Ernakulam branch of SIRC of ICAI to introduce our Chairman of Accounting Standards Board of ICAI, CA MP Vijay Kumar.
A very good evening to all of you. Indeed, a great moment of pride and pleasure for me personally to be introducing before you a guru material for all of us, CAMP Vijay Kumar sir, the Chairman of Accounting Standards Board of ICAI. He is a fellow member of the ICAI, a fellow member of the Cost and Management Accounting Institute, a fellow member of the Company Secretary Institute. He is also the current CFO of the famous SIFI Technologies, which is listed with NASDAQ with operations in India, North America, Europe, and Singapore. Prior to that, he was a partner to the firm Yoganand and Ram Chartered Accountants. And even prior to that, from 92 to 99, he was the head of investment banking and company secretary of the Sundaram Finance Services Limited in Chennai. He was listed among the 100 most influential CFOs in 2015 and in 2016 as well. And in 2017, he won the national award from the then Honorable President of India, Dr. Pranab Mukherjee, for his contribution to financial accounting by Capital Foundation Society. He is a Honorable Central Council member for all of us from the year 2016 onwards, and has been holding very crucial and key roles as the chairman and vice chairman of very, very important positions. He is currently the director of SIFI Singapore Private Limited, also director of National Internet Exchange of India, which is a central government sponsored entity. Tejo Engineering Limited, first company to be listed on NSE SM platform, also audit committee chairman of theirs. He has been a great contributor to Confederation of Indian Industries, CII, and also the vice member of Institute of Directors. He is also a member Academic Council of ICT Academy of Tamil Nadu. a member of the Institute of Internal Auditors of Florida, USA, and the Vice President on their Board of Governors of Chennai chapter. He is a teacher in financial reporting and corporate laws for over 20 years now, and for professionals across India, Middle East, and Southeast Asia on IFRS, Indian accounting standards, corporate laws, and governance. His books are like the landmark or probably the epic. If on a personal note, if I can say, I have qualified my CA final exams only with the help of the great book by Vijay Kumar sir. These few very little words, with humble respect, we welcome Vijay Kumar sir. Over to you, sir.
Thanks, Ranjit, for that extensive introduction and those kind words. I was extremely happy to also hear Sreevats Gopalakrishnan at the end for a few minutes. In fact, there's so much of positive appreciations I hear about him. And he had done some lectures for the Accounting Standards Board video series. So happy to hear him too.
Thank you, sir.
So greetings to all the members present here. Sincere thanks for the invite to be part of the valedictory session. I'm thankful to MJ University and the Managing Committee of Ernakulam branch of ICAI for having coordinated this faculty development workshop. As we speak, I was looking at the chat box. I'm very excited to see the feedback from the participants. In fact, the participants may not be aware. All the managing committee members of the branch are all senior practicing chartered accountants who give their professional time, voluntary and without any remuneration for the cause of overall professional development and also for dissemination of knowledge across various sections of the society. And I'm happy that all of them are present here today. In particular, I need to give credit to Mr. Roy Varghese for his perseverance in coordinating this session. I sincerely thank all the faculty members and pay my sincere respects to all the participants in this 4-day workshop who are all by themselves very knowledgeable people and faculty members who are shaping the future of the country through these bright young minds getting trained under you for your participation in this 4-day workshop. But for your participation, I don't think the workshop would be termed as a success. I will take this opportunity to highlight a few thoughts for all the faculty members present here to deliberate into the future. And I invite each of the faculty members here who constitute the intellectual property of the country to join hands with the Institute for more research in the area of accounting and auditing. I strongly believe that accounting is about being accountable and financial reporting is a communication. Just like personally, in our personal life, all of us want communication to be truthful and complete. In financial reporting as well, it is very important that the communication has to be truthful and complete. The financial reporting has made a significant leap in terms of staying relevant and continues to go through changes in this very, very dynamic world to stay relevant. I will highlight 7 key changes in this context. First, as I was hearing Sreevats at the end, he was talking about off-balance sheet liabilities getting recognized in IFRS or Ind AS in the financial statements. I'm sure all the faculty have touched upon some element of Ind AS. And Ind AS or IFRS, for an outsider, it looks like a complex accounting literature. But I want to share with each of you here that between accounting standards and Ind AS or IFRS, which we can use interchangeably, both are the same, except that in IFRS or Ind AS, there is a higher emphasis on three elements. One on fair value, second on substance or form, and third on disclosures. All these three, fair value is there in accounting standards, it is there in Ind AS also. Substance or form is there in accounting standards, it is there in Ind AS also. Disclosures similarly are there in both. But in Ind AS, we have a little emphasis. I just want to give some examples on these for a deeper understanding of why the higher emphasis. Let's take the first element of fair value. If we look at our experience of financial statements, it is at present historical cost based, and think of a 20-year-old organization, 30-year-old, 50-year-old organization. The balance sheet captures the assets all at historical costs. And over this period of 10, 20, 30, 40 years, in an inflationary economy, we know that the values at which you report in the balance sheet are not relevant to a user. The user knows that the true value of the enterprise and the various assets is different. So the users of financial statements start speculating on what could be that probable value. So lack of information about what is today's value, we are putting the users to a disadvantage, where the users, since they don't find the information relevant, they would just leave it and search for other sources of information. Just like when you or I cook food, we derive happiness when the food is eaten by the persons for whom you have cooked. Similarly, financial reporting also, if it is not being used by the user, the investor and lender community, who are called as primary users of financial statement, all the effort we put in for preparing the financial statements has no meaning. The midnight oil you burn and the literature you try to comply with. I'll give an example of how fair value is embraced at a higher level in Ind AS. It is there in AS as well. I said all of these three are there in AS also. For example, in Ind AS, we have what is called the revaluation model for property, plant, equipment, intangible assets, and in IFRS for investment property. So when you revalue the assets, you are communicating to the user of financial statement what is the current worth of the asset. You are not giving him some historical information, particularly after depreciation, which is an irrelevant number. So you are giving the user what is worth of today's assets. And in the balance sheet, property, plant, equipment, intangibles constitute a significant part of the assets. There will be some criticism, like historical cost is an actual number, fair value is subjective, there's a valuer and all. But when it comes to fair value, the valuers are all subject to certain standards of valuation, and my own experience, and you can cross-check, the differences in value will be within a very narrow range of maybe 3 to 5%. For example, if we take employee benefits, gratuity valuation, actuarial valuation, that is also fair value. You take the top 10 listed companies. When you do the fair valuation of the gratuity liability, actuarial valuation, there are assumptions relating to salary growth rate, interest rate, etc. And if you look at all the companies, these assumptions you would find are consistently used. For example, if the interest rate is 7.5%, almost all companies would have used the same 7.5%. If somebody uses 9, the liability and expense figure will come down, but nobody attempts that. Because actuary is a profession, it's a valuation profession. There are some guidelines. At best, somebody may use 7.4, somebody may use 7.6. It's within a narrow range. Look at the benefit of giving historical cost, which is an irrelevant number, 20-year-old. Imagine Tata Steel, Tata Motors, those balance sheet figures, what value they have. But if you have a revalued figure, then the user knows, yeah, today approximately this is the worth of the assets. And on revaluation, the profit does not go to income statement. It goes only to the other comprehensive income or equity, in simple words, equity. So it doesn't increase your divisible profit. It doesn't increase the profit available for distribution, PAT and all. The second and very, very important positive element of accounting in the revaluation model. All of us know we are in an inflationary economy. One of the purposes of providing depreciation is to provide funds for replacement of the asset. So if the historical cost is 100 and you provide depreciation 10, 10, 10, the amount of funds which you have retained is 100. 10 years later, that 100 is not sufficient for replacement, not sufficient. So the same organization for sustainability has to bring in fresh capital to even survive. In inflation accounting, we call it physical capital maintenance. If we follow revaluation model, then depreciation every year is provided on the revalued number, which means you are providing a higher amount of depreciation, holding back higher amount of profits inside the company, which will be available for replacement. The third element of fair value, matching concept. Your income statement has income during the current year at its current year price levels, and the expenses, materials, wages, etc. are all at current year price levels. The depreciation, which is also one of the important expenses, that is at some old historical cost number. So income is at today's price level, current year price level. Materials is at current year price level. Wages, etc. are at current year price level. But depreciation is at some old price level. When you do on revalued basis, that is also at today's price level, and there's a true matching concept. So that's the beauty of revaluation model. The second positive aspect of moving to India is higher emphasis on substance over form. Let's take a very simple example. I am a company X Limited with a share capital of 500 crores. I can expand by setting up a branch operation which is part of the same X Limited. So end of the year, branch and head office income, expense, asset, liabilities are added. I can alternatively set it up as a 100% subsidiary. Instead of calling it branch, it takes the form of a subsidiary. So subsidiary is a separate legal entity. But we all know whether you call it a branch or a subsidiary, both of them are coming out of the same 500 crore capital, both of which are controlled by X Limited's board of directors and management team. So the users of financial statement of X Limited should know what is the income, expense, asset and liability at the subsidiary exactly the same way they would know what it is if it is a branch. So that is the application of principle of substance over form. Legal form, it is a simple investment, but in substance, it is my assets, liabilities which I am controlling. The income, expense are all derived from my actions, and X Limited shareholders should know the income of the entire 500 crores capital which is there. The third aspect is higher disclosures. When it comes to financial statements, particularly when we use judgment, when you have fair valuation, estimates. In fact, if you look at the balance sheet, almost the whole of the balance sheet is an estimate. Almost the whole of the balance sheet. Property, plant, equipment, cost less depreciation is an estimate. Investments lower of cost and fair value is an estimate. Inventory lower of cost and NRV is an estimate. Receivables less provision for bad debts is an estimate. Your liabilities, whether it's taxation, gratuity, almost all are estimates. So given the fact that there are so much estimates and judgment involved, it is important the user should know what are the underlying assumptions while making those estimates, and hence the focus on disclosures. And let's understand, friends, when it comes to financial statements, there are investors using their hard-earned money to invest in the company, and there are lenders who are dealing with public money and lending to those companies. And for all of them, it's important we give them information for appropriate decision making. Now let me come to point number 2. Point number 1 was accounting standards to Ind AS or IFRS. Point number 2. The purpose of financial statements, you would have heard in AS 1, is twofold. A, to understand the past, what has already happened. B, extrapolating to the future. So when somebody reads financial statement, he should be able to understand what happened earlier, and he or she should also be able to look into the future. And majority of the users use financial statements for extrapolating to the future, as past is history. When somebody invests money, He wants to know how the company will do tomorrow. When someone lends money, he wants to understand possible cash generation in future for repaying the loans. And hence, it's very important that financial statements should give enough information to a user to extrapolate to future. All of you here are faculty members, and my experience, I've been a teacher for close to 20 years. The best time to mold the future of the nation is, and I'm sure you will all endorse this, is when they are students who are learning something which they are going to practice for a long time. If we are able to explain to the children at that age the right purpose of why disclosures are required, why a particular accounting principles need to be followed, then that will sink so much into them. And what sinks into them at a foundation level, it cannot be replaced or shaken later. And disclosures, generally I have found, today if you look at most financial frauds, most of the problem comes because people hold back information. They hesitate to disclose. Disclosures are important. For preparer, he knows everything. Promoter knows everything. Management knows everything. But the people who have given risk capital, equity, are somebody else. The lenders are public money. Public money. Today, all of you in your public deposits with banks are earning interest rate of 5.5%. Reason is, banks lend at 8 or 9%. They consider bad debts losses of 1.5%. If those bad debts were not there, you and I, for our hard-earned savings, instead of 5.5, would have got 6 or 6.5. And probably business enterprises would have got loans at 8%, and many more projects would have become viable. So it's very important that the financial statements support the future. Third, there's a concept of integrated reporting and sustainable reporting which is developing, particularly given the experience around organizations' inability to survive environmental and other changes. There's a lot of focus happening on sustainable reporting. And for large companies, it's a matter of time before it becomes mandatory. I'd like to then take you to point number 4, goodwill for impairment. All of you would have heard through your sessions that when you acquire a business, if I pay a consideration of 100 and I get net assets of 80, that difference 20 is called goodwill. The extra money you pay is called goodwill. And goodwill as an intangible asset is tested for impairment whenever there are indicators. And goodwill is treated as part of that cash generating unit which you have acquired. But there's a very nice concept evolving, and I would strongly request all of you to take up research where there are many instances where the extra 20 I've paid is not for the extra value which I'll get from the business I'm acquiring, but it is for my existing business to do much better. My existing capacity utilization is 60%. Because I acquired this business, my existing business capacity utilization goes to 75%. So that extra 20 crores is actually belonging to this entity, this division. So that's a nice concept currently at research stage, not yet brought into the accounting standards. The fifth element, as the future progresses, management commentary explaining the performance and all will become part of financial statements. Today it is external. The idea is once it's part of financial statements, they will all get audited as well, and the users of financial statement can rely upon it more reliably. Point number 6, the format of financial statements is undergoing a substantial change. 4 years from now, you will find a different format of income statement. So work has progressed on this internationally and shown in India as well. Last point, number 7. Some of you might be observing that there are changes happening in accounting standards or their voluminous. I just want to share with you, these changes are because of changes in the business environment, business models, and economic environment. The accounting is very simple if the transaction is simple. It becomes complex when the transaction gets structured or becomes complex. I'll give a very simple example. I have a host of examples, but I'll give one example. And this is a live experience for me a year and a half back. I'm sure there are many senior faculty members in this workshop. If I were to go 20 years back in time, any sale which is done is a simple sale where a product is sold, invoice is issued, 1,000 rupees, matter over. If you today take a sale transaction, and I'm talking about an optical shop, glasses, optical shop, very small one. I had been with my daughter to buy glasses for her. So I picked up glasses, a frame for 700 rupees. As I was about to invoice, the person came and said, "Sir, if you pay extra 300 rupees, anytime in the next 12 months you want to buy, you can buy the next pair of glasses at a 50% discount. Anytime. You can buy now or anytime in the next 12 months. These are called sale with loyalty rights. So I raised an invoice of 1,000. 700 rupees is for the current product. The balance 300 is a loyalty right for which he has to fulfill an obligation. So these kind of sale transactions are all becoming a reality now, and hence the need for extensive guidance, and that's why some of the standards change. So let me conclude here. Thank you all once again, and thanks also for your patient listening. Best wishes, stay safe and stay accountable.
Thank you, MPV sir, for that wonderful address. And before we wind up, we will hear from the representatives from MG University also. I may request Dr. E. Sulaiman sir for his final comments.
Good afternoon, everybody.
Yes.
Today we are on the closing ceremony of our faculty development workshop. Today we have one of our honorable guests, Vijay Kumar sir. Thank you for coming to our workshop, participate our workshop, and your wonderful speech. I am amazing with your speech, because we are all teachers. How do you take it in a different angle? That is, I really appreciated, sir, for your within a few minutes you are actually wonderfully taken elicit more ideas from your part. That is actually more useful to our teachers, because how do you present the things before the students? That may be useful to our especially our faculty members. But today I am really not a director or organizer of this workshop, but also and the last 4 days, I have really participated. Actually, when I am one of the participants, and throughout the workshop, I actually participate. What are things going on there? All these sections, from the beginning to the end, all the sections are more informative because we are teachers, as you know, that majority of these teachers are not yet updated with the recent events happening on accounting field, as well as I am not shameful to say that many of our teachers are actually following the outdated textbooks. These things are actually shameful to our teachers, but I am really revealing the fact that we are referring these outdated textbooks and delivering the old ideas before the students. So that is nothing useful to students. So when we go through this workshop, I think many of our teachers could get what are actually recently going on in the accounting field. And actually, this subject itself, accounting stand, is I think that really not most widely discussed in our faculty development workshop, because even our training colleges, especially we see academic staff colleges there. In that college itself, we have some refresher courses that may be taken there. But even in that refresher course itself, this subject is not takes place there. They are discussing any other subjects, but these accounting subjects and the recent developments in accounting subjects, these are not takes place in the part of the program itself. So it's entirely a different program. I think that that is why majority of the participants already mentioned that is more informative, because we didn't get any much idea about, even in our faculty development and conducted by the UGC also, they are actually neglecting this area. So I really appreciate the ICAI Ernakulam chapter to take this subject, and also without any remuneration itself, we have got 4 or 6 wonderful resource persons. They are engaged in different subjects very beautifully. Thank you for ICAI for taking this initiative. Thank you.
Thank you, Sulaiman sir, for that nice words. Thank you very much. Now, may I request Professor Sajiman sir, the representing Management Studies of MG University, for his comments also.
Okay, thank you, Joseph.
Apologies.
Thank you, Joseph, for inviting me. And this was a wonderful session. The whole faculty development program, including the last day session, today's session, where Vijaykumar MPs are also coming and giving nice words and talks about the subject. It's really motivating to all the faculty members who are participating in this particular program. And in fact, Sreevats sir already mentioned about the involvement of university and all. I just want to, I am actually standing here for Dr. Robin Jacob, who was supposed to be part of this particular voluntary function, but because of his some urgent work in university, he is not able to. So actually, when Roy Varghese sir was interacting with our Honorable Vice Chancellor Sabu Thomas sir to discuss about the possibility of having this kind of workshop. So the Sabu sir has given this to Dr. Robin Jacob, because that is, he is heading the quality initiatives taking in the MG University. Actually, as you all know, now we all coming under a different kind of accreditation process. Now, how we go for industry-institute interaction, it is one of the things which we have to take care of. So then our IQSC was taking this as an opportunity for MG University to have a program with maybe an industry. Actually, it worked well. So it was actually started in that way, but it is later come up with a very good, fantastic and wonderful FTP program where many could be benefited from this particular program. We are actually thankful to the ICAI chapter. We were
With your permission, I'll take leave. Part of another meeting now.
Including the, yeah.
Thanks a lot for all the kind words.
Thank you, sir.
Sir, big thanks to you, sir.
Thank you, sir. Thank you, sir.
Because your support, that's it.
Thank you, sir. Thank you.
Okay, so including this resource, today's resource person, Sreevats Gopalakrishnan, for the wonderful sessions you have carried out today. And actually, there was very good feedback which we have been looking for the last 4 days. including some of the suggestions coming that there must be some program for students also. Of course, university is all open to go with such programs with maybe hand in hand with ICAI chapter of Ernakulam chapter for all the wonderful programs which are coming in the future days also. So thank you very much for associating us to this particular wonderful program, and thank you all for this session. Thank you very much.
Thank you, Sajiman sir. Thank you very much. And we have come to the end of this 4 days workshop on accounting standards. May I request our chairman to conclude this workshop with your yes.
When I discussed with Joes also, I think, as well as Sajivan sir, they were telling that it is me who is the right person to finally conclude this session with a big thanks to all, because I don't know, it was a big dream for all of us to conduct such a workshop. And as Sajivan sir, Sulaiman sir said, it was a relentless follow-up from to Sabu sir as well as to Sajivan sir, to Sulaiman sir, everyone, and to the faculties and everything. More than that, I think we were contacting Accounting Standards Board and seeking their support. They were very much enthused to go for this. And ultimately, it all happened. Thanks, a big thanks to Sabu sir first for his excellent support for this program. He's a wonderful personality, a great personality, academician. I think he was here personally, and though he is speaking very less, he's more having more knowledge. I feel that, I think the way I knew about him, it was wonderful. So thanks to Sabu sir. And for getting Sabu sir, I had the support of Lucas Joseph sir, I think one of the past chairman. He helped me a lot. Then Sajivan sir and Sulaiman sir came in between. It was a contact between them, and they all helped in conducting this program and organizing this program. Big thanks to Sajivan sir and Sulaiman sir and entire MG University, all other faculties for their support, and to our excellent faculties. When I contacted each one, Vinod Balajendran or even Asif Mohammed or Sreevats Gopalakrishnan or even Parveen Kumar, they all readily agreed for this program, because accounting standards is one area which we want to, that information we need to disseminate to the public, not only to the public, the students as well as the faculties. So they all readily agreed. Big thanks to all the faculties for the excellent presentation. I don't know, everybody appreciated it. Great, big thanks to all of you for the wonderful support, and to the backup team at the ICAI office. Raju, Shinu, Tessie, and Victoria Madam, everyone, they were all supporting in conducting this program, in organizing this program in a wonderful way. Big thanks to them, and to my managing committee. We are 7, and with that 7, there is Babu sir, Babu Brown, Galivila, and Jamwan sir. Without Babu sir's support, I think this would not have happened, because he was there to push us out to go for it. Anyway, big thanks to Babu sir, Jamwan sir, as well as to the entire managing committee for making this a wonderful event. Definitely, as you said, as you wish, we will be there for more such programs. Even the Accounting Standards Board chairman himself came to know about this, and he will also be there to support us. Big thanks to all the participants for their support. Great work. And one thing, we will be sending you the materials and the certificates. We will go through the norms first, and definitely all those who deserve it, definitely they will be getting the certificate as well as the materials. Thank you very much. Thanks a lot. Big thanks to all.